Hello and welcome to Portfolio Matters. We are back. Normal schedule resumes as Richard has returned from his extended holidays. But before we get into it, Richard will read the disclaimer.
Thank you very much, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, thank you, Richard. Before we get going, a quick note on advertising. We have had feedback saying that you are all getting more advertising on YouTube. We don't accept advertising revenue from YouTube. We are not a member of their partner program, but I've read the terms and conditions, and sadly, they can still push advertising onto our channel despite the fact we gain nothing from it. It is a price of using the YouTube service, I'm afraid, and there's nothing we can do about it. Apologies all round. Okay, news this week. Well, the Bank of England kept interest rates of 5.25% in a tight vote, 5 votes to 4 to keep rates unchanged. They said very little about the future path of interest rates. They did, however, say that they would increase QT next year from the current 80 billion to 100 billion. The Fed also kept rates the same at 5.25 to 5.5%, and they then issued a hawkish statement saying they were prepared to raise rates further if appropriate, and they intend to hold policy at the restrictive level until they're confident that inflation is moving down sustainably. Now, we've also talked in recent weeks about the US fiscal balance, and that was positive in August due to student loan repayments. So the forecast that the 2023 deficit would be better over the next 2 months, so August and September, seems to be correct so far. So in the US, the United Auto Workers have gone on strike, closing down production at selected plants at Ford, GM, and Stellantis, which is Chrysler. And they're demanding a 40% pay rise over 4 years, reduced 4-day, 32-hour week, etc., etc. Pause and take a look. This is quite a big and important battle. Russia has banned fuel exports, they say, to bolster domestic stocks, but is that just to tighten an already tight market? And finally, the global bond sell-off continues and has caused equity markets to fall this week quite sharply. So this is the market's expected outlook for US rates, and the black line is now, the blue line is in June, and you can see that now the market is starting to believe the Fed will keep rates higher for longer. When you look at the dot plot, you get some interesting results. So if you look at 2026, half the Fed FOMC panel believes that they'll have to cut rates quite hard, and the others don't. And the reason the market and the Fed are talking about holding rates higher for longer is that they have revised upwards their forecasts for US GDP growth and down their forecast for unemployment. So they think that in order to create some slack in the economy and keep inflation under control, interest rates are going to be higher for longer. Now, turning to the UK, the market does not believe that the same is true in the UK. So after the Bank of England held rates, the expected path of UK interest rates fell, and it's fallen over the past few months. So we know, and actually we're going to go through the data this week on UK inflation, that UK inflation does seem to be coming back down actually quite fast. And turning to the US fiscal deficit, they had a surplus of 89 billion in August, thanks to a surge in individual income taxes. And this is the UAW strike, and that's going to affect Ford, GM, Stellantis, and that will have knock-on effects throughout the supply chain and will probably reduce US industrial production for this month by a bit. Let's see how long it lasts. And this is Goldman Sachs's forecasts for Q4 growth. And what they're saying is that student loan repayments, which we've talked about before, will reduce GDP growth in Q4 by about 55 basis points. A possible US government shutdown will reduce it by another 20 basis points, and the UAW strike will reduce it by 5 to 10. So there are some headwinds for the US economy in Q4. And this is the number of days lost to strikes this year in the US. A lot. Let's see how long the UAW strike lasts. And talking about US government shutdown, well, the probability has surged in the last few days to the best part of 80%. And the length of the shutdown has also increased. So markets are now forecasting that it will last 13 days. So both sides seem to be becoming more entrenched, and markets are pricing in a greater probability of a government shutdown and expecting it to last longer. This is Russia. This is their shipments of diesel, which is quite a lot, actually. So best part of, 800,000 barrels a day are now going to come off market. And finally, this is US 10-year note, which surged enormously yesterday, leading to a global equity market sell-off. We will discuss more on that later. Now, finally, a correction. So last week, we were talking about how the US fiscal deficit had been exacerbated by tax deferments allowed to the weather-hit states of Alabama, California, and Georgia. And I said that payments would become due on the 15th of September. Well, I was wrong. It's actually October the 16th. And so that affects tax payments, I believe, for 2022. They should have been liable in April. They have got a 6-month deferment, and that's October. And California is 14% of US GDP. So when those tax receipts come in, that should reduce the US deficit. And it could well be that the very high US deficit this year is a function of those tax deferments. And as we discussed last week, how US citizens could also defer their taxes by 6 months and take advantage of the fact that they can keep the cash they would pay in tax on a deposit account of 5%. So lots of people have done that. We're just going to have to wait and see what happens to the US budget next month. And on to this week's economic data. Richard, the UK.
Thank you, Keith. So UK CPI month on month at 0.3% in August. And as Keith said, the UK inflation rate has now in the last couple of months started to drop quite quickly from what was a very elevated level.
Yeah, no, this was really good because we were expecting higher oil prices to mean that August inflation leapt, but it didn't.
Indeed, yeah. So, and UK CPI year on year now a little bit below 7% and falling fast.
Yeah.
So fingers crossed it continues to fall. But of course, the oil prices have gone up significantly, so they may just feed through a little bit late with a little bit more of a lag.
Yeah, still very high levels, sadly.
Yeah, exactly. UK core CPI month on month, 0.1%. So almost no inflation in August for core CPI.
Yes, this was a fantastic number, actually. Expected at 0.6, came in at 0.1. And if you look at the last 3 months, they're pretty much on target for 2%.
Yeah.
Brilliant.
And there's core CPI year on year, which obviously we've had a couple of good monthly readings, but at 6% is much too high.
Yeah.
And UK RPI, which is a graph we don't like to look at because it's even worse than CPI, 9%. I think the cost of living crisis is not over. I can understand why the Bank of England didn't raise rates, but we're not out of the woods.
So before you move on, Richard, I agree with you on the Bank of England. I think the Bank of England's right that monetary policy is restrictive enough. And in the FT this morning, we've talked about this before, monetary policy acts with long and variable lags, and 800,000 UK homeowners had to refinance in H2 this year, another 1.6 million in 2024. So as they refinance, their mortgage costs are going to go up, and that's going to slowly suck demand out of the economy.
Yeah, and that process hasn't finished by any means yet.
Yeah.
CPI H, restaurants and hotels accommodation services annual inflation rates in the UK is actually dropping pretty quickly, isn't it, Keith? I mean, the rate of increase has dropped from 15 down to 7. Whether that's due to supply and demand, of course, partly. Food price inflation is falling sharply.
Yeah, that's great news.
Yeah. As we've discussed, rising oil prices, they obviously contributed a substantial amount to transport costs in August, and other major contributions of one way or the other to inflation. Food and non-alcoholic beverages, significant downward pressure on the rate of inflation. Restaurant and hotels, housing and household services quite high.
Yeah, but actually some decent deflation in a few categories, food and restaurants.
Definitely. The biggest contributors to inflation by category, we've got food and drink. I don't know how much they haven't classified this as sort of essential food versus discretionary food, but that's bad news for low and middle income families, particularly. Alcohol and tobacco. Health high. I mean, those numbers are, if you look at them like that, they are still starkly high, aren't they? The only ones that I consider to be anything like appropriate would be education and transport.
Yeah. We have a section on agricultural prices coming up.
And here we have inflation rates, CPI compared across a selection of G7 countries. So you can see that the UK is the highest, but it has caught up with, let's say, it is catching up with the falls by the European countries that happened ahead of ours. The US is way out ahead in controlling its inflation, although that's quite a nasty tick up that they've had.
Yeah. No, it's remarkable how we have caught up, actually. We're no longer the bad outlier.
Yeah, we were just slow in catching up. UK input PPI year on year is actually negative, which is good news for prospective inflation rates. And UK output PPI year on year is about 0 now, which is again good news for prospective inflation. UK consumer confidence climbing, still very low. It was roughly 0 in 2016. It's climbed from nearly -50 to -20 in quite a significant trend there. So that is looking better.
But still bad.
Still bad, yeah. And UK retail sales month on month in August were quite good, actually, after a poor July.
Yeah, but missed expectations.
Yeah. UK retail sales year on year are still below 0. So,
and worse than expectations.
Yeah, it's not a particularly healthy environment. UK public sector borrowing requirement month on month. It would be just nice to see some blue bars there, wouldn't it, Keith?
Yeah. Well, we did have an unexpectedly good number in July, and the guidance is that the August number, though pretty terrible, actually was better than expectations. The OBR had been forecasting 13 billion. It came in at 10.7.
I think the problem is that the expectations are just are very poor indeed, and we're beating very poor expectations, but it's still not good. And the government is incapable of balancing its budget, despite the hefty levels, the very high levels of taxation that we have.
Yeah.
So the UK economy is showing signs of some resilience in August. Retail sales bounced a little bit. Consumer confidence is continuing to improve, but as Keith pointed out, absolute level is still pretty low. And inflation, whilst much too high, is actually falling from the much, much too high level it was at. And we've got flash PMIs out later today.
Okay, thanks, Richard. And on to the EU. Only a bit of EU data this week. And the good news was that we had the second revision to EU inflation for August, and that revised inflation down from 0.6 to 0.5%. Still a big bounce on July. And year on year was also revised down to 5.2% from 5.3% previously. So EU inflation is coming down, but ticking down slowly. Core, that's still very high. Now, we also had construction output, and in July that bounced actually much better than expected. So the month on month in July, it was up 0.8%, bouncing from minus 1.2% in June. So the EU construction sector has some life, although you'll notice that the June number was revised down hard from minus 0.3% year on year to minus 0.8%. EU consumer sentiment is falling again, unlike in the UK. So that was below expectations and down on August. Now, this morning at 9 a.m., so actually after we started recording this, we will get the EU PMIs, but at 8 a.m., they announced the French PMIs, and they were terrible. So manufacturing came in at 43.6, well below estimates at 46. Services was awful, down 43.9. That's deep contraction. And so the composite was 43.5. That is deep recession territory, I think. Although you did actually have this period in 2012, 2013 when we were down at these levels. But you can see the momentum is not looking very clever.
I mean, I think Europe is problematic. I think we have to wait and see really whether they've had huge manufacturing problems with energy prices.
Yeah.
They're highly indebted. In France, the proportion of government to GDP is far too high. They've got the French banks, which are in a very dicey, dodgy position. I just think Europe is not in a happy place.
Actually, you raise a very good point, Richard, because we previously talked about how France was very highly indebted. And I think this is showing that France is sensitive to Eurozone interest rates. And Christine Lagarde, of course, last week raised interest rates yet again. If we turn to Germany, Germany had a bit of a bounce this month. So the September PMIs show that manufacturing, failed to deteriorate further, I think is all you can say. That is a really bad number. But the services did have a bounce, actually back towards neutral at 49.8. So the composite actually is still pretty bad. It's 46.2, so in recession. So let's see what happens with Eurozone PMIs out later today. We will be reporting those next week.
Yep.
Now, the good news is that the PMIs showed that service pricing pressures in both France and Germany continued to fall. So that should be good for EU inflation. So in summary, the EU economy looks like it's declining towards recession. But the good news is inflation should continue to come down. And on to the US, Richard.
Thank you, Keith. So this shows US import prices month on month, which actually have been negative for a year and apart from April, and are now starting to creep up, which suggests there is a little bit of inflationary pressure coming into the economy from imports. At 0.5%, that's quite a chunk. And import prices year on year, well, I think basically we can just see the impact of that rise with that uptick in the year on year figure.
Yeah, I think a lot of that is to do with oil.
Yeah. Export prices month on month, very healthy increase for the US. Good for the US balance of payments, presumably, assuming volumes are remaining constant. And year on year export prices, having plummeted, are now seem to be reversing that process a little bit.
Yeah, I really think this is energy prices, LNG and oil.
Yeah, you may well be right, Keith. It's a very broad figure, isn't it? US industrial production month on month, nice bit of growth there, although as Keith pointed out with the Union of Auto Workers and their substantial demands, which presumably would take a long time to resolve. I suspect that we're going to see declines in industrial production over the next few months.
Yeah, I mean, what they're doing is incredibly disruptive, but quite clever. So they're putting different plants on strike at different times. They're not closing down the whole of Ford or GM. Right. They're basically trying to disrupt production as much as possible while minimizing their own, time off.
Yeah. Well, of course, the downside of that is that Ford, for example, may decide just to shut the factories down. It depends if they can't keep the production lines going. We'll have to see. The demands are extraordinarily high. And this is a question of the allocation of profits to capital and labour, isn't it?
It is.
This is a pushback saying, well, Labour wants more of the allocation of profit, and all you billionaires need to give some of it up. Which one can't argue with.
No, I agree. It's an important fight. The car makers have made a lot of money in profits over the last few years, and the unions are saying they haven't shared it out. Yeah. But, globalization pushes back on the union's ability to extract those extra salaries when if Ford can just move more production to Mexico, then, it undermines their pricing power.
I know, but maybe they think because of the reshoring impetus in the US that their pricing power has suddenly gone up.
Yeah, it's a good point.
Maybe it has and maybe it hasn't. I think we'll see, won't we? Okay, so US industrial production year on year is pretty much flat at the moment.
Yeah, but better than expected.
Yeah. Still no sign of the US recession in manufacturing. And there's US manufacturing production month on month. And US manufacturing production year on year, just slightly negative. US Michigan Consumer Confidence Index is really, it's bouncing up quite nicely, isn't it, from a very low point?
Yeah, the last couple of months it started to fade again.
Yeah. And US consumers much more pessimistic than the current economic conditions would suggest. So since the pandemic began, America's been gloomy despite the strong economy. So the actual, is the light blue or green, depending on your perception of colour. And the light blue or green line is much lower than the expected based on economic data. Much lower. And actually, there's a pretty good coincidence between the actual and the expected, which has basically broken down.
Yeah.
Suggests that these surveys, the expectations, there are factors that are at play which expectations don't take into account.
Well, it also suggests to me that COVID lockdowns had a terrible effect on people's mental health and has made them fundamentally more pessimistic.
Yeah, and which needs to be factored into the calculation of expectations.
Yeah,
I mean, I think COVID lockdowns, we haven't seen the last of them, and ultimately, I think democracies will come out and say they were really, apart from the first one, they were a really foolish thing.
Yeah, completely agree.
Ultimately will happen. Sorry. So this is the US Michigan current conditions survey, which is again showing a rise from a very low level, probably a trend, but as Keith said, you've got this downtick in the last couple of months, and it's below expectations. And there are the US Michigan 1 year inflation expectations, basically down to 3%.
Yeah, this is great.
Yeah,
actually, and unexpected given the rise in oil prices.
but remember, historically, inflation comes in waves. So the US Empire State Manufacturing Index is such a noisy chart at the moment, isn't it, the last few years? Anyway, it's sort of at zero, but it could be anywhere between 0 and minus 20, I suspect.
Yeah, it's funny the way that, the Empire State, they're so volatile. So it's bounced to plus 1.9 in September. But then if you look at the Philadelphia Fed, it's deteriorated. It's like every month it seems that manufacturing activity oscillates between New York and Philadelphia.
So you have to sort of try and take a trend, don't you? Ignore the noise. And if you do that, it's roughly at zero, I would say.
Yeah, I agree.
So although the Empire State Manufacturing Index bounced in September, the employment component weakened. And the US NAHB Housing Market Index is all over the place, really, isn't it? So reached its nadir a couple of months ago, bounced back up, and now is on its way down again.
Yeah. Now, this has been a real puzzle for us because we know, and we've got a section on US housing affordability coming up. We know housing affordability has been terrible, but house builders have been incredibly confident. But I'm going to read this out. This is the commentary. High mortgage rates are clearly taking a toll on builder confidence and consumer demand, as a growing number of buyers are electing to defer a home purchase until longer-term rates move lower. They're saying that actually, finally, higher rates are affecting home buyer demand in the US.
Yeah. Very, very slowly. So US building permits are basically they're sort of pretty much back on the trend line that they have been on since 2010, which is sort of in a sense not unexpected given that the US population, I think, is growing. So obviously they've got a lot of immigrants coming through from Mexico. So you would expect that they need to continue to build houses. So there seems to have been a sort of huge glitch. And then is it back on trend? Month-on-month building permits is 6.9%, which is like vastly greater than expectations. So the housing market is defying what people expect to be happening to it.
Yes, but
housing starts are falling away quite fast.
Yeah.
They're minus 11.3 against expectations and minus 2.5, which is a big deviation from expectations.
Yeah. And they revised down the July number. So contradictory signals. Permitting up, starts well down. And actually, we've shown the NAHB Home Builder Confidence Index well down. Now, I take your point about the US needs to build houses, Richard, but you can build all the houses you like. If nobody can afford them, you can't sell them. So, let's see what happens.
Yeah, no, I agree, Keith. Existing home sales basically fell off the cliff, and they're remaining at the bottom of the cliff, really. And month on month, existing home sales, they are there's a little bit of an upward trend. They're still negative, so that existing home sale market is in poor shape. And this is a Conference Board leading economic index, which has fallen again in August. And the year-on-year change is the blue line. In leading economic index, so it's looking pretty sickly, and the year-on-year change in real GDP is actually looking not too unhealthy.
Yeah, the two should be more correlated than they are. And actually, it's not index, it's indicator. That's my fault.
Okay. So, and as the LEI continues to forecast recession. Red Book retail sales. In the summer, we've had very good retail sales in the US, and August maybe just tailed off slightly. But
actually, that is week on week, Richard. So
yeah.
that's, last week it's tailing off a bit.
Yeah. And the mortgage rate is back to a new high since 2000. And is going to continue to affect the housing market, although slowly. And the MBA mortgage market index is really very low and showing no signs of perking up at all. It's in a poor state. Initial jobless claims to the US have fallen, which suggests that the US employment market is healthy. And continuing jobless claims basically sort of plateaued, which suggests the US job market is stable.
Yeah.
And continuing claims are running about 30% above last year's levels, but initial claims are not. In other words, there's been an increase in unemployment, but that increase has passed. It's not being reversed, but neither is it continuing. So the jobs market does seem to have stabilized a bit in the US.
Yeah.
So the US economy continues to be resilient. We continue, and I continue to think the outlook remains uncertain, and the interest rate rises. You would still expect to be pushing the US towards recession, and the leading economic indicators continues to forecast recession. Industrial production was stronger than expected. Consumer confidence is falling. We've got mixed data in the housing market, with permits going up and new starts falling. Retail sales are falling. Jobless claims are showing no signs of a sustained rise, and possibly a stable job market. So there we are.
Yeah, very uncertain outlook. But I continue to believe that very high interest rates will slow the market, but also headwinds now start in the form of US student loan repayments beginning in October. And then something that everyone seems to be ignoring is the fact that these deferred taxes in California, Georgia, and Alabama, was it? So that explains quite a lot of the huge US fiscal deficit. Plus, we've got a potential government shutdown and striking UAW workers. So a few headwinds there. No Chinese data this week. And onto one chart. And so this is student loan repayments in the US, which we've covered over the last few weeks. And there was this huge surge in repayments in August, which we have now seen actually led to the US government having a fiscal surplus in August. But that surge has now passed. And so what we can conclude is that students who had saved money during the pandemic have used that money to repay some of their student loans before interest started accruing again in September. And so actually those loan repayments came from savings. They didn't come from income. Hence, US retail sales in August were pretty good. The problem is that in October, everyone has to start repaying their student loans, and that will come out of income. And on to agricultural commodities, Richard.
So we can see that these 4 agricultural commodities have risen very substantially since 2020. So we've got sugar, olive oil, cocoa, and orange juice. So this subset of agricultural commodities are showing significant high rates of inflation and no sign of falling back. So the question is, what's going on in the agricultural sector in general? So this is the price of canola, which is dropping. And here we have cheese, and kind of standard cheese, presumably. And my Stilton hasn't gone down in price like that.
I think this is American cheese. Richard,
really
probably have difficulty getting rid of it.
Processed milk stuff.
Yes.
So the price of this processed milk stuff has dropped. I was showing downward trend. Corn is on a significant downward trend. and cocoa is not. Supply is very tight, and cocoa is definitely not on a downward trend. Coffee was high and has almost halved from its 2022 highs. And milk, the milk chart should really follow the cheese chart, shouldn't it? So there's the price of milk, which is not inflationary. And oats have risen actually quite substantially, and with a little bit of a sharp pullback. There's orange juice, spelled with the S, as we like to spell orange juice.
Sorry, that's me.
And you can see that the price of orange juice is showing no signs of dropping back. There's palm oil, very stable. Soybeans, well, up from where they were, but fallen back from their highs. And sugar, which is basically launching, looks like it's launching a new attempt at an all-time high, if it's not even got one. Wheat has really fallen right down from its that spike that it had, and the price is quite weak.
Yeah, and that's despite, the disruption to Ukrainian wheat supplies.
Yeah, and that's the food price index, which is generally following, obviously, the quantity, large commodities, large trading commodities. So although we've got a few outliers which are showing significant inflation, in aggregate, food prices continuing to fall. But climate change having a severe impact on those four commodities. And there's the reason.
Yeah, thanks, Richard. So Andreas Steno Larsen, in constructing his food price shock index, has just cherry-picked these four, which are all subject to climate change. In general, food prices are continuing to fall. That's good news for inflation. Okay, now on to recession timeline. And we last did this back in March. And reminder, this is the hope graphic, which purports to show how a standard recession evolves. So the first indicators turned down are National Association of House Builders, followed by permits for house building, the ISM manufacturing new orders, etc., etc. Now, we went through it last in March, and we're going to go through it again to see where we are in the recession timeline in the US. Okay, so we covered this earlier, but this is the National Association of Home Builders Housing Market Index, and it has had a strong bounce, but is now falling over again, falling quite sharply. Building permits, though, not rolling over. They have fallen sharply earlier in the year, but have since stabilized. ISM manufacturing new orders, having fallen sharply beginning of 2023, are really stable now. The long-term view, that is not a good number, however. US consumer confidence seems all right, but is fading again, as we've talked about. And, its absolute level is very poor. But then, as Richard was talking about earlier, it seems that people are just a bit more pessimistic post-pandemic.
Yeah.
Manufacturing new orders, consumer durable goods, actually, that looks all right. Mm-hmm. Helped by resilient housing market. People who move homes generally have to buy new white goods, etc. And the latest data point is 7.3% growth year on year, very respectable number. Manufacturing production, however, is poor. Capital goods, new orders, actually looks all right, although it's fallen recently. Latest data point is 4.6% year on year. That's perfectly acceptable. Industrial production year on year doesn't look great, but not terrible. Average working hours are pretty much back to normal, but latest data shows no deterioration, below average. Non-farm payrolls are falling, and they're falling back towards, I'd say, what is now an average number, but not nowhere near zero or negative. Real personal incomes have actually been growing, up 3.8% year on year, as wage growth and now outstrips inflation. Core CPI is falling. So if we look at these, then the picture basically just doesn't work. So we are not seeing the deterioration in the housing market and the manufacturing sector that precedes a recession. In fact, where we're seeing the most weakness is in the employment market, which should react later to a slowdown. So it's as though the normal order of a recession has in some way been disrupted and reversed, because we were now having falling inflation, falling working hours, but actually a pretty resilient manufacturing market. So if we have a recession this time, and Rich and I continue to believe that we will do, then this particular framework hasn't worked, because actually the housing market has been much more resilient than you would have expected, given the rapid rise in interest rates. Now, this is from March, just to reiterate. So they were then pricing in a 78% chance of recession, which just hasn't occurred. But Fidelity, if you look at their cycle indicator, they think the UK and the Eurozone are already in recession, and the US is close to it. So in conclusion, the HOPE framework is not forecasting an imminent recession in the US, because this doesn't appear to be a usual economic cycle. I think the rise in 30-year mortgages in the US has meant that the connection between rising interest rates and a weakening housing market has been fundamentally weakened. In fact, the whole monetary transmission mechanism in the US has been slowed.
Yeah, as it has in the UK. Okay, so inflation watch. UK 6.7% falling, US 3.7% rising, EU 5.2% falling, Germany 6.1% falling, and Japan 3.3% unchanged. So the general trend is downwards. UK RPI is a bit of an exception, which is 9.1% in August, rising. Now we know about RPI. It's an old-fashioned indicator of inflation, and it was changed because it was reading too high. No, it was changed because of statistical improvement, I'm sure.
Yes.
So then what have we got on interest rates? So UK 5.25, the US 5.25 to 5.5, the EU 4.5. When's the EU meeting to discuss that, Keith, is it?
Well, they had it 2 weeks ago, and they raised, and next one's 10th of October. Actually, not far away.
No, so the question is here, will the EU raise or not? I'm looking at those flash PMIs that Keith put up for France. One wonders that they might actually stick and see what happens.
Yeah. But again, that PMI from France just reiterates that your ECB is trying to set one interest rate for very divergent countries in the EU. Yeah. And France, highly indebted, clearly are very sensitive to interest rates in a way that Germany isn't.
Yeah, exactly. Very difficult job. So US trueflation, which I think, I wasn't sure whether it was true or not, but actually with benefit of hindsight, it clearly does work quite well, I would say. Would you agree with that, Keith?
Yes, I would.
So this is suggesting that US inflation has steadied at about 2.6%. No sign of an increase yet. And as we've discussed, US food price inflation continuing to decline in August, although food away from home, because you've got restaurant costs and so forth, not declining so much.
But still declining.
Still declining, yeah.
So we know that CPI includes owner equivalent rents, which, we've talked about many times, is a lagging indicator. And the orange line is if you strip out owner equivalent rents and instead use market rents. And what you see is by using market rents, CPI would be much higher back in 2022 and lower now. So the fact the US uses owner equivalent rents actually has really distorted their response to inflation. If they'd had market rents, then they should have reacted much sooner to a bigger surge in inflation. As it is, by using this ridiculous owner equivalent rents, which was, put in there in the 70s specifically to dampen down inflation, then they failed to react as quickly as they should, and now they're overreacting.
So Goldman Sachs claim that the US labour market is pretty much back to normal. And actually, if you look at where all these various lines lie, they are converging on the pre-COVID areas.
Yeah, but they're converging on, the economy being at a pretty decent level. They're not, converging on market weakness.
Well, of course, the question is, will they continue to their trajectories, and will they then deconverge?
Yeah.
And much of the recent fall in US wage growth has been due to the falling premium for switching jobs, which suggests that the labour market tightness has fallen away. And inflation for salaried workers is around about 6%, 5.5%, which is high.
Yeah.
But we did talk about the fact that capital earlier. Capital has taken an increasing share of the profits of the US economy for many years, and at some point, in order to avoid social unrest, that needs to change. UK trueflation has dropped sharply over the past month, but look at that, 9.2%.
Yeah, not great.
Because of the sharp drop in energy bills.
Yeah.
And the market is expecting UK inflation to creep below 5% by the year end. Qualified good news. So inflationary pressures look like they're continuing to fade both sides of the Atlantic. We saw that UK has now, its inflation is sort of roughly coincident with Europe. We don't know why there is a timing difference, but the US is in a much, much healthier place. I don't know, do we have any European trueflation numbers, Keith?
No, we don't, sadly, no. And on to Recession Watch. Now, in previous weeks, we have talked about the trajectory for US savings, and this purports to show the outlook for US savings, which will continue to fall. And according to this chart, it means further headwinds for US consumers, and they are forecasting that a recession is likely in Q1 next year. Now, turning to credit markets, well, the blue bars are loan standards, which we know have been tightening for quite a long time now. And as you can see, they are correlated with high yield default rates, which are picking up, but from very poor levels, very low levels. But high yield bond spreads just aren't reacting to that increase in default rates. So the market seems extraordinarily complacent about corporate financial health. And Apollo are saying that they think that a new default cycle has started in the US. This is architectural billings. Now, before you start a project, you employ an architect. So architectural billings are a very long leading index for the housing market, and particularly multifamily, and they've been in decline, negative, below 50 for 13 months now. So expect some weakness going forwards in new apartment builds. Turning to the UK, London rents, UK rents and London rents are rising at a record pace. Now, this is a side effect of the increase in mortgage rates, because buy-to-let mortgages are by and large on variable rates. And so as mortgage rates have risen, so have landlords' costs, and they are passing that on to their tenants. And that will tend to reduce their disposable income and tend to reduce consumer spending. In China, goods exported to the rest of the world continue to look poor. So Chinese goods exports, world trade, not looking good, and that's corroborated by falling shipping rates. Shipping rates have collapsed from during the pandemic period, and they're now fading again. And if we look at global leading indicators, well, they've had a decent bounce actually, but to still pretty poor levels. And the US yield curve continues to forecast a recession, although that recession forecast is getting a bit stale now. Doesn't mean it won't come. So in summary, the UK and European economies seem to be heading for recession. US leading indicators continue to forecast a recession, although the economy still appears resilient. Headwinds grow in Q4 and Q1 next year. And on to soft landing watch. Now, Florian Kronawitter, who I generally like, is forecasting that the US economy will now begin to recover and has actually hit a cyclical bottom. And he's doing that partly on fiscal grounds. Now, he is pointing out that fiscal flows, daily, i.e. the daily fiscal balance, is running at twice pre-COVID levels. So the US government is spending much more than it's taking in. And part of that is due to the CHIPS and the IRA, so Inflation Reduction Act, which are leading to a big increase in infrastructure investment in the US. So you can see that between August 22 and June this year, we've had a huge increase in Inflation Reduction Act energy security spending on credits and incentives. And this is the pipeline of $1 billion plus mega projects, although it does include Canada. So there are a lot of big projects incentivized by the CHIPS and IRA Act that are under construction. And so he is now saying that he expects the fiscal flow and bank credit flows to bounce from here. And he's saying that he sees bank lending picking up. Now, let's have a look at bank lending. Well, bank lending these are the week-on-week numbers. And you'll see that over the last month, there has been a pickup in bank lending, but really not by very much. And the most recent numbers show it's faded again. And we know that small banks in the US are under a lot of profitability pressure. I doubt very much we're going to see a sustained rise in lending from the US when interest rates and the cost of funding for US small banks is so high. And I have updated my credit impulse chart, and it does not look good. So I disagree with him on credit flows and increased bank lending in the US. And also, we know that next month in October, student loans begin, and that these deferred tax payments for lots of US citizens have chosen to defer their 2022 tax bill, and California, Alabama, and Georgia all come in. And actually, I think you're going to see fiscal tightening. So I disagree with him on that. And if we look at the San Francisco Fed Daily News Sentiment Index, which is not something we've covered before, it's volatile, but it has turned positive for the first time since March. And the recent upturn in the ISM manufacturing PMI could be a harbinger of S&P 12-month forward earnings growth, says. It's another one of these dodgy correlations, but if you believe in a soft landing, and good news is that actually the US labor force participation rate is improving and the labor force is growing back towards its pre-pandemic trend. So that's good news for wage inflation in the US. Now, if we've covered this before, and the bears are all pointing to the rising cost of servicing consumer debts in the US, and that is the orange line. But if you look at it as a percentage of disposable income, it's really not too high. This month, we've had a good Empire State Manufacturing Index, and one component of that, the expectations for business conditions 6 months ahead, has really improved over the last few months. US manufacturers, or New York State manufacturers, are buying into the soft landing. And the Citigroup Economic Surprise Index continues solidly positive. And this is cross-border capitals, GDP now, world forecast for the world. And it's saying that the world continues to grow actually pretty well, although growth has been fading. And this is Goldman Sachs forecasts for 2023 GDP in various areas of the world. Take a look. Bottom line is that they think the world economy is actually doing all right. The Atlanta Fed GDP now forecast is still at a very healthy 4.9%, and the St. Louis Fed GDP nowcast, having been negative, is actually now at 1.7%. So Q3 GDP in the US looks to be decently positive. So to my mind, a lot depends on the outlook for the US fiscal deficit. I think, as we've talked about, there's more tax receipts coming in October. Let's see what happens. And on to US housing affordability, Richard.
Thank you, Keith. So, a shock to housing affordability. So, housing affordability in the US has plummeted to the level it was at in around about 1986, or maybe 1985. That's obviously because of the increase in interest rates, the massive increase in interest rates coincident with the increase in prices when interest rates fell.
Yeah.
So basically, interest rate policy shoved prices up, and then they tightened interest rates really fast, and prices haven't adjusted to interest rates, and affordability has plummeted, which suggests, doesn't it, that one of the things being equal, prices need to drop substantially. And that, of course, is why existing home sales aren't dropping, because are falling away, because people can't afford to sell. Either they can't afford to sell, they're going to negative equity, or they haven't got themselves adjusted to the reality that prices need to fall. So
So, Richard, but also because they've got these 30-year very low interest rate mortgages, and if they move, they lose the mortgage.
Very good point. Yeah. So new home buyers are likely to struggle to gain a place on the housing ladder until prices drop.
Yeah, but they're not. They're rising,
Yeah. And
it's amazing.
And that means, that we see all these building permits. This must be for land that has been bought at prices that anticipate higher land prices, that anticipate high selling prices. And the whole system needs to, if interest rates remain at this level, the whole system needs to equilibrate, and it will be very painful for some players. Alternatively, they can drop interest rates and it all goes back to normal, in inverted commas. And as an aside, I know we've been talking about why aren't the recession models working and so forth. I do wonder if one of the reasons they're not working is because we've got such massive distortions going on in the economies of the world, that the basis on which things happen has changed from previous events. Massive QE, COVID, post-COVID, massive indebtedness of both governments and corporate indebtedness. And I just wonder whether there's a lot of distortion going on that's messing up the models.
Yeah, no, I agree with you, Richard, because what's happening, if you look at the US housing market, the one thing we know about the economy is that prices are much less flexible downwards. So wages, house prices, they have downwards inflexibility. And so when, they pump up really fast because everyone likes rising house prices, but nobody likes cutting them. And so now what you see is, the whole housing market is just gummed up because nobody wants to sell and realize a loss. Or
very good point, Keith. Yeah. So this is actually a chart that just shows the interest rate rises, and this is we have the interest rate rise, a massive interest rate rise. And in the next chart, we have the conclusion that it's much cheaper currently to rent a home rather than buy one. So the prescription is rent until prices drop.
Yeah.
Multifamily housing units under construction is an all-time high.
Now, actually, I had a look at this because I was concerned about this, that this seems to be growing for a long time. And I looked at the underlying data, and actually they are completing some of these, because it just seemed like this can't go on. Are they just not completing them? But they are completing, a decent number every month, and the number of new construction is slowly falling away.
As a result, US citizens now need an income of over £100,000 to qualify for a mortgage. I mean, this is this is the sort of comes back to this issue of capital and labour share of the economy. And effectively, the labour share of the economy has proportionately declined dramatically, particularly when it comes to purchasing a house.
Yeah.
And these ultra low interest rates have totally skewed the normality. So it basically it's locked, I don't know what percentage of the US population out of being homeowner.
Yeah. But, point is, Richard, that home builders and home sales have been amazingly strong in the US. And actually, house prices have been rising in recent months. I mean, it's just mystifying. At some stage, given we know that, everyone on less than $100,000 a year can't buy a house and affordability is really stretched, surely at some stage that changes.
Exactly. Yeah. Yeah. So mortgage applications to buy a house have declined to a 30-year low, which shows there is a lot of pain to come out of the housing market yet, doesn't it, Keith? And although housing starts are rising, ultimately, what drives the housing market? It's new buyers coming in at the bottom.
Well, that is the August drop is quite sharp, actually.
Yeah.
When you look at it, these are all annualized rates, of course.
Yeah.
Actually, sorry, that should be July. But anyway, the July drop.
And US new home sales are rising again, having had a rather steep fall.
Yeah, that's just absolutely mystifying. I mean, I would like to know how people are affording this.
And that shows prices have stopped falling. They didn't fall by terribly much, about 10% or so. And they've started rising now, temporarily possibly. But the index has turned down. So we have some conflicting information coming through at the moment. And mortgage defaults versus unemployment. So we've got very low unemployment and we've got very low mortgage defaults.
Yeah.
So the resilience in the US housing market is a puzzle, remains a puzzle. But I continue to believe that the housing market will fall away eventually.
Yeah.
Affordability is very poor and deteriorating.
Well, it's still deteriorating, Richard.
Yeah.
We've seen that, the mortgage rate continues to rise week on week. And it's going to have had a really terrible week because, US bond yields continue to rise. So at some stage, surely this breaks.
Surely it does. But it's not breaking at the moment.
No. Another thing we've been wrong on. Or I've been wrong on.
So watch this space.
Yeah. And onto other charts. And we showed you this last week. Reminder, Chinese property is very, very expensive. So in Shanghai, the home price to income ratio is 50. In London, which is really expensive, it's 17. In New York, it's 10. So housing in China, just ludicrously expensive. And obviously you buy those houses with mortgages. And that means that Chinese citizens have taken on a lot of debt. And as house prices struggle and home sales struggle, so developers are getting into trouble. And as they default on their loans, that means the trusts that have been lending them money are also getting into trouble. And they are therefore cutting back their exposure to the property sector and starving it of credit. Now, so in every other case where we've had a bursting property bubble, so we're thinking about the great financial crisis in the US or the 1990s property bubble in Japan in particular, but also the Asia crisis, a crisis in the property sector, because it relies on so much debt, rapidly leads through to a financial crisis. And watch this space. So when property prices in China are at 51 times income, if, for example, prices fall by 10%, then homeowners will have suffered a loss equivalent to 5 years worth of income. So those are huge numbers. Expect if you have falls in Chinese property prices, that will feed through to a financial crisis. And I thought this was interesting. This is a chart of Chinese workers going on strike. I would have thought if you went on strike in China, you ended up in the gulag. But actually, there are lots of strikes this year. And Chinese local governments are rushing to sell bonds at a decent pace. As the property sector slows down, normally Chinese local governments fund themselves by selling land. Now they're selling bonds. And this is a chart from back in 2022. And it's a reminder that China is publishing fewer statistics. So the Chinese economy is increasingly opaque. And also we know that they've basically issued a warning to statisticians to be not too pessimistic on the economy. So we had to be increasingly wary of Chinese government statistics. But they do seem to be pumping liquidity into the economy, and pause, take a look. When they've done that previously, the economy has tended to rebound. Will that be the case this time? Against that, you'd say that reinflating a property bubble, always difficult. And on to good news. And pause, take a look. This is interesting. So this is the carbon emissions and the GDP growth of various countries. And what you'll see is that all these developed and developing nations have managed to keep on growing GDP while cutting their CO2 emissions. So great news for the world is that being green is not incompatible with rising living standards. And on to equities. Richard.
Thank you, Keith. So we have the FTSE All World Equity Index, which is basically bouncing around between 440 and 460. It has been doing so since June, so it's a quiet summer. It's at the bottom of that range, but in the last year, it's gone up from 380 to 440, so a substantial increase.
Bad week though, down 3.3%.
Yeah. Here's the FTSE All Share year to date. So it's at 4,171. Basically, it hasn't really gone anywhere year to date.
I should say that all this data is from close Thursday night.
The Euro stocks, again, really hasn't gone anywhere. It was trading quite a tight range. Hasn't gone anywhere since the end of January. S&P 500 has had a very good year, as we know, but is now falling away again. I think the rising interest rates are starting to spook a little bit. The rising bond rates, so showing significant sort of downward momentum at the moment. Yeah, and the Nasdaq Composite, which again has had a very good year, but since July has been falling away gently. And a new one for Portfolio Matters, the Russell 2000, which is a smaller index of smaller companies in the US and probably more akin to what's going on in most of the economy. Hasn't really done very much this year, although it's been quite volatile and it's falling quite fast from its late July, early August high, down about by about, what's that, 10%.
Yeah, well, it's down 4.6% this week.
Yeah,
and the reason I've added it is that we know that the main street in the US, so the big bulk of smaller companies, are much more sensitive to interest rates because they are funded by bank debt. And we saw last week how their interest payments have risen sharply in the way the S&P 500 companies which issued bonds, their interest payments have not risen really much at all. So I find it very interesting the Russell 2000 has basically done nothing this year. It shows that actually the economy in the US, I think, is weaker than you would expect just by looking at the largest companies.
That's a very good point, Keith. Here's a Hang Seng, which has actually had a very poor year, particularly a very poor period since the end of January, and probably because it's tied quite closely to the Chinese economy now. We're very unclear about what's happening to the Chinese economy. Well, we are clear about it, but the Chinese don't want us to be.
Yes.
The Topics has had a good year and actually hasn't shown the recent declines that the US markets have shown. The Bitcoin has really done nothing since March, I would say. And the pound against the US dollar, it had a good run up from March. It's now having a good run down. Yeah.
As the Bank of England failed to raise interest rates this week, sterling's weakening again.
But also, I think our overall level of indebtedness, public sector borrowing requirement, the fact we're much outlier economy, lots of things, aren't there, Keith? I guess we're not in a very comfortable place as a country, as an economy. Euro, US dollar showing exactly the same issues. Keith and I read an interesting article yesterday forwarded to us by a friend, which basically said that the UK and Europe are so grossly over-governed, and the government forms such a massive part of GDP, around about 50% now, that the economies can't recover because government control of the economy in that manner is very inefficient and starves the private sector of resources in many ways. So, whereas the US isn't in that position, which the conclusion of the article being that Europe and the UK end up as poor relations of the US, and I have to say, it's not an unreasonable thesis.
No, the thing is, I read the article, Richard, and I completely agree with it. But at the same time, I prefer to live here than in the US with its very high levels of inequality, because that is the trade-off. If you have very high levels of inequality and a low safety net, then absolutely people are incentivized to work very hard to keep themselves off the streets. And so in Europe we have 5 weeks holiday a year, and in the US they have 10 days, and I'd much rather live here. But the flip side of that is that we have lower growth potential.
That's a very well made point, Keith. Yeah, I agree. I suspect this balance. I don't think we need to be as indebted as we are and have such big government as we have.
Yeah.
I suspect the balance is somewhere in the middle.
Well, back to your earlier point, Richard, about the second and third lockdowns. I mean, that was just, destroyed, that really raised our debt levels to what end? Destroying people's mental health, etc., etc. Don't get me started.
That's my line, kid.
Yeah.
So the dollar index, the dollar's having a strong run now. It's up 5% since July. The VIX has perked up because of the recent decline in the indices, and it's all the way up to 17.5. And Keith, I'm sure you'll update us on your VIX trade shortly.
Well, I'm still on my VIX trade because we've bought it when sold it when it's dipped below 20. You sell it again when it goes above 25, and then buy it when it goes above 30. So it's cost me money, but it's pin money playing around with it. But that is still in buy territory.
Yeah.
So anyway, it's weird. The very low volatility of the equity markets is odd.
Fear is back on as of Friday morning, i.e. today.
Yeah.
Well, we're approaching what was it, October the 14th, was it? Black Monday.
Mm.
We have seen secular. So basically, this is showing different bull markets, and we've been in the secular bull market for a long time now. And when bear markets occur, they can also last for years. See the black lines. And are we going to go into a bear market?
Yeah.
One would think possibly so. Earnings optimism is back, and earnings expectations continued to rise in recent weeks. That's the S&P 500. S&P 500 equal weight in white, and you can see the EPS projections for the next 12 months have recovered their lost ground.
I'm mystified by this.
Yeah. And what's this chart showing us, Keith?
Well, this is consensus S&P 500 EPS estimates. And, so they're forecasting 9% year-on-year earnings growth in Q4, and then strong earnings growth next year. And, this is despite very high interest rates and bond yields. And there's just, the economy does not look strong. You are expecting a strong recovery, and the US economy to be able to live and thrive when interest rates are at 5.25%. I just don't get it.
Not when they've gone up so fast from such a low level.
Exactly.
And there's basically a discontinuity. So falling trade services inflation implies a fall in corporate profit margins. It does. Not an increase. And buybacks, well, higher interest rates basically stymie buybacks, don't they? Because the cost of the debt to do the buyback is much, much greater.
Yeah.
It's no longer a free lunch. And goodness me, look at that. Buybacks have been the largest source of equity demand since the GFC. So what's the source of the rally in stock market since buybacks? Non-financial corporations in red.
Yeah.
Massive.
Okay, on to commodities and energy commodities. And surprisingly, Brent actually ended down on the week. So still well above 90. But I was expecting when Russia announced that they were going to stop exporting diesel, that the oil bull market would accelerate. It didn't. But still a big bounce from its lows in July. This is WTI consolidating above 90, but again, down on the week. And if we look at data specific to the oil market, a surprise build in US oil inventories for the second week in a row. So although everyone is forecasting that the oil market will go into deficit or should be in deficit now. It's we've had 2 surpluses in a row in the US, but Baker Hughes rig count is responding to rising oil markets, and the Baker Hughes rig count rose by 2 last week. So this is very worrying. This is Bloomberg's expectations for the balance in the oil market. And they're saying in Q4, they're expecting a deficit of over 3 million barrels a day. If that's true, I think oil shoots above $100. And that is a further headwind to the world economy, but also really bad for inflation. And a reminder just how big the oil market is compared to other commodity markets. You know, it's enormous. Thank you to Uncool Tom for sending us that. It's basically the size of all the other ones combined. Actually, double the size of all the other ones combined. And now natural gas futures. Well, not good news. We are entering the autumn-winter period where we start burning gas in Europe, and gas prices in Europe rose by 8.6% last week. Now, I've included this week the 10-year chart, and you'll see that although gas prices are well down on last year, compared to their pre-pandemic average, they're much higher. And Richard was talking earlier about how industry in Germany is struggling with higher energy prices. Well, we could yet have another gas price spike this winter. Good news is European gas storage is pretty much full. And this is UK gas prices, really not great. Very similar chart to EU ones, but prices rose by 11% this week. And thought this is interesting. This UK is now the top destination for US liquid natural gas exports. We have been outbidding the Far East.
Filling up our reserves, presumably, Keith, and hopefully.
Well, I don't think we have any reserves, do we? We've kind of reopened the rough storage facility.
Filling that up.
Well, yeah, exactly. That takes about 15 minutes because they haven't been able to open it fully. Yeah. This is US natural gas prices, and they really haven't recovered very much. Still pretty low. Coal recovering with oil prices, uranium off to the races.
Absolutely. So I have, as people who watched before the summer, because I haven't been on for a little while, as you know, apologies for that, but I have got, my portfolio has some uranium in it, and it's the uranium aspect of it has been rather languishing over the summer, but it is perking up a little bit now.
Excellent. Well done, Richard. And on to industrial metals. What?
So,
well, you know, compared to me, fucking, you know, positive, anything is bloody doing well.
You'll be fine, Keith. You will be fine. It's just painful waiting for you to be fine, if you see what I mean. So aluminium, I mean, pretty stable, hasn't done much for about 3 months. Cobalt, really quite a difficult chart to interpret. The price isn't going up or down. Copper is, it's oscillating, is it? Can't get below about 3.5, can't get above about 4. Obviously, if the Chinese economy and the building sector really is in trouble, then the price of copper will come under pressure from that. But you know, electrification of the world needs lots of copper, so counterbalancing forces. Chromium is fairly steady. Iron ore has had a little uptick, but not doing anything particularly spectacular. This is interesting. Iron ore prices rising as inventories at Chinese ports fall. So Chinese inventories dropping. Of course, Chinese inventories are dropping maybe because Chinese demand is falling.
Well, the commentary is that the government has been mandating a certain levels of output from Chinese steel mills.
Right. Oh, so flooding of the market then.
Yeah. Well, it's command economy, isn't it?
Yeah. So I have lithium, which has really been fairly lackluster over the summer. Neodymium. One of the big drivers for neodymium is wind farms, and wind farms are running into the sand, if you'll pardon the pun, at the moment. So we'll see. Nickel is still going down.
Actually, while you're on that, Richard, in Europe and the UK, I would expect that much higher long-term interest rates are going to really impact big infrastructure projects like wood farms, because your cost of developing has just gone through the roof.
Yeah, in fact, it has become a more normal economic judgment as opposed to a no-brainer. Let's borrow as much as we can. It doesn't matter what we spend on it. We spend it on. We've only got to get 1% return, and we're quids in.
Yeah,
I sort of exaggerate, but
the thing is, Richard, I just don't think that big infrastructure investments like that work very well at these interest rates, because the reality is, wind, etc., are much less efficient than burning oil and gas. Sadly.
Nuclear.
Yeah.
Uranium. There's the price of tin, which has basically not done much since April. Ferrovanadium, which we really keep an eye on because of A, batteries, and B, ferroalloy resources, which we've all got an eye on to see whether it ever picks up again.
Yeah.
Zinc.
Yeah. So in general, I'd say a pretty poor week for industrial commodities.
But a quiet 3 months.
Yeah. Precious metals.
So gold is up 5.6% year to date. It's sort of been very quiet, really, since March. But interestingly, it's been very quiet against the background of the rising US dollar and rising US interest rates.
Yeah.
Hasn't hit by those.
Yeah, I think it's been actually very impressive performance.
Yeah. And silver, I think, basically, with some sort of volatility, mirrors the price of gold, or vice versa. Platinum, who'd want to be a catalytic converter, eh?
Yeah.
Same comment.
Yeah. Has the rhodium market just died?
It looks like it, doesn't it? Yeah. And palladium, same thing. Okay,
and on to rates. Thank you, Richard. So UK base rate was unchanged, and a terrible week for me, frankly, as the long end shifted up. Now, you can't really see this here, but this is quite an odd shape for a yield curve. So you're getting, I don't really know how to interpret this. It's saying that medium term is between 15 and 30 years. Investors demanding a 50 basis point yield premium for lending to the UK for 10 years. Seems really odd. So long-term UK real interest expectations appear to be rising, and that is certainly the case in the US, where base rates are unchanged, but the whole yield curve has shifted up. Now, you would expect that will have an increasing effect on the US housing market and investment, because what's happened is that although the Fed has not raised interest rates, the markets have tightened financial conditions. They're basically saying they demand a higher yield to lend to the US government. So the risk-free rate has gone up, and that will raise interest rates throughout the economy. So these are current US market interest rate expectations. And the market is pricing in a slight chance that the Fed continues to raise rates over the next 3 months, but then it's expecting rates to start falling. Now, the market believes that inflation long-term will be about 2.3%. And so current yields, which are best part of 5%, so current interest rates are restrictive compared to long-term interest rate expectations, and the market is demanding increasingly high real yields. Now, part of the reason they may be demanding real yields is that the Treasury is issuing loads of bonds to fund the deficit. And we talked about this last week, that Saudi Arabia is no longer recycling its petrodollars into US Treasuries. In fact, it's selling them down. However, it's not a general case that everyone is selling US dollars. It seems that it is restricted to countries with difficult relations with the US. So China has been selling down its treasury holdings, as has Saudi Arabia. Essentially, the sanctions and seizure of Russia's treasury bonds has led to other regimes with difficult relationships with the US selling down their holdings, unsurprisingly. But that makes it more difficult for the US to sell its huge issuance this year. But if you look at the macro outlook is quite weak, and it suggests that yields should be falling, not rising. And they shot up this week.
So I would just like to chip in there, Keith, and say that we've got this very distorting effect of ultra low interest rates. And it's one of these things where I'm not sure that the previous trends are actually sort of the economy is operating in the same way now as it did with previous trends. And there's a lot, I think this massive, so interest rates gone up from, let's say, 0.5% to 5%. So that's a tenfold increase in interest rates. Yeah. Not 4.5%, it's tenfold, i.e. 1,000% increase. I think that's a discontinuity for these economies. And I think, therefore, previous correlations can break down quite easily.
Yeah, well, I agree with you, Richard. It's but the US economy has been just amazingly resilient, and I've been very wrong.
Yeah.
So in a no landing scenario, Societe Generale are forecasting that US 10 years could head towards 5%. Now that implies basically that a flat yield curve, and the market assuming that interest rates in the US will be at 5% for the next 10 years. Seems absolutely extraordinary to me. But I've been very wrong so far. And this, I thought, was an amazing chart. So this is real yields. And you'll see that not so long ago, during the pandemic, real yields hit -1%. And then they have shot up to over 2%. So a huge 3% move in 10-year break-even rates. Sorry, 10-year real rates. In Europe, in 5-year forward, inflation expectations are now the same as in the US. That seems wrong. It seems that, do we believe that the EU has now escaped its low growth, low inflation trap? I mean, Richard's point earlier about, just the huge proportion of GDP that is government spending in Europe, and it's, causing it to have structurally lower growth, would seem to be an apposite one. And bonds, I know to my cost, much more volatile than gold now for the first time in 45 years. Now, this is what happened in 2006-07. The Fed raised rates and then held it there for a long time, even as CPI fell sharply to below target. And in doing so, it broke the economy. Will this time be different? Now, one of the reasons that bond yields are rising so fast is that CTAs, so commodity trading advisors, they're hedge funds that follow trends. And as yields have trended up and bond prices have trended down, so they have been shorting bonds, and they now have a record net short position. Now, crowded trades are dangerous. They can go on far longer than you expect. They can push prices way out of whack, but then they unwind very quickly when everyone rushes for the exit. So this is the story of bond yields. Basically, they have ignored falling inflation surprises, that's the light blue line, and they've followed the economic surprise index up. So growth is surprised on the upside, rates have followed. Pause and have a read. Basically, I think medium term, when the recession starts, then bonds are a huge buy. But in a highly market-based economy, it could well be that the recession doesn't start until the equity market has a good old sell-off, and that hits consumer spending. So we know that so far the US economy has been resilient. Let's wait and see. It looks like the bond market won't, it looks like bond yields won't really start to fall until we get a good sign of a recession, and they could rise further before then. But when the recession comes, history suggests the Fed doesn't gradually reduce interest rates, it cuts them hard. And that's my plan. So, so far I've been terribly wrong, but I'm expecting recession, and when the Fed cuts interest rates hard, then bond yields do well. But so far I've been very wrong. Okay, so this is UK 2-year. Expectations coming down. 10-year. The 30-year moving in the opposite direction. And that has really caught me out. Surprising. So this is the US 10-year. That is a huge move. It was up by 12 basis points yesterday. And, how high can this go? Interest rates of 5.25 to 5.5%. So you're looking at quite a flat yield curve now. And the market is expecting US rates to stay very elevated for the next 10 years. This is German 10-year, still high, not coming down despite the fall in European inflation. Italy 10-year still rising. Greece rising. Any change to your views, Richard?
No.
Right. Okay. Well, mine, for what it's worth, no. But I've been very wrong so far this year. So, in summary, both the US and UK held rates steady this month, but interest rates, so interest rates appear to be peaking as inflation falls. But it was a very bad week for bonds and for equities. Now, next month is an important month because that should clarify the path of the US fiscal deficit. And from that, we should be able to read whether the US will have a soft or a harder landing. Richard, how are you doing this? How have you been doing since you last were on?
So I will do a proper update one of these weeks. But basically, over the summer, I have done nothing, literally nothing. So for the last 6 months, I have done nothing. So my portfolio consists of precious metal shares, industrial commodity shares, and uranium miners, and some cash. And I am about 1.5% down on the year. So the miners haven't performed as well as the precious metals have. I would expect that to revert in due course. And my plan is to do nothing, make no changes to my portfolio over the next few months. How about you?
Well, I had an absolute shocking week again. Very depressing, and I'm having a terrible year. Unlike Richard, In fact, like unlike everyone else, I have been wrong on my call that of an imminent recession, and bond yields have been absolutely going against me. Now, I think that the sell-off in my portfolio is slightly exaggerated, as the particular bonds I'm in seem to have a particularly bad day yesterday, but the general picture is really bad. And I'm not looking very clever, not feeling very clever. And at the bottom, so what you all know that I play the cycle, and I was expecting the cycle to turn and therefore sell out of equities and buy bonds, but I've been frankly just way too early. I mean, when I look back at the forecast for recession in March, I very much believed that we would be in a recession by now. So I have one bullet left and I haven't fired it, basically. So I'm holding off from going totally all in on bonds, but lost a lot of money, and I need a recession now to get back to zero. So the thing is, the losses are mark to market. I've got no gearing, and I could just hold these and get inflation plus to maturity. And reminder that RPI is 9.1%. So, that is not trivial. And
it's not trivial at all. And it puts the losses, the capital losses, which are unrealized, into perspective.
Yeah. So T68, which I've got far too much of, it's got a real yield. So if you buy it now, you're expecting inflation to be 3.4% for the lifetime, which I just think is wrong, and the real yield of 1%. So you get inflation at 3.4% plus 1% extra, and as that will be a capital appreciation, that is pretty much tax-free. Now, so you think about 4.5% tax-free per year. If you're a higher rate taxpayer and you were trying to get that from a deposit account, you would have to be getting something like 7 or 8% to get that post-tax. So, not looking very clever, but I just don't think that A, I think these are actually a very good investment at this point, and B, I just don't think the UK economy can live with real interest rates at this levels, unless you have a huge house price crash. So bottom line is, I'm not doing anything. I'm waiting to fire my last bullet at this this trade, I call it. And if I think at these levels, frankly, I could just retire from the game and just live off the capital and 1% real yield.
But, which is just up your street, I know.
But I like a bit of stress, but not this much stress, frankly. As you all know, I take a lot of risk, and this time it's completely blown up in my face. But I do like a bit of volatility, just not this much. Anyway, I hope you are all having a better year than me. Anyway, so welcome back, Richard. I was going to say I was going to resist the temptation to call you Specky Four Eyes, but I couldn't.
Thank you very much, Keith. Just you wait till you get old like me.
Yes. So anyway, on that mature note,
yes.
It's goodbye from Richard.
And it's goodbye from Keith. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.